Hello students and welcome to this video on revenue. This is a question called Perfect Cupboards that I have made available to you. You can go and retrieve it, and I think it's a very good example of a revenue question that has a few tricky things inside of it that you have to keep in mind. Right, we can read together. It says question 4, and Perfect Cupboards Bty Limited is a company that produces a standard size of cupboard to a wide range of customers. It uses a perpetual inventory system. Very important. Cost of sales need to be calculated when a transaction takes place. Financial year end is 31st December, and the markup is 40% on selling price. Very important, on selling price. During the year ended 31st December, the following transactions were entered into with regards to IFRS 15. And there they've given you three different notes. So in note number 1, they say on 1 January 2015, 10 cupboards were sold at a selling price of 3,500 Rand each. Each, the word each, very, very important. It means that 3,500 Rand is not the collective total. The customer will make the following payments. On 1 January, they'll make a 10,000 Rand payment, which is an immediate payment because that's also the transaction date. Then you will see on 31st December 2015, there's a 16,500 being paid. And on 31st December 2016, there's a 17,080 Rand that is being paid. The applicable interest rate is 22%, and this financing is considered to be significant. Then in note number 2, they say a customer purchased 25 cupboards on 1 March 2015 at a selling price of 4,000 Rand per cupboard. Again, per cupboard, very important. The customer received a 10% discount for buying in bulk, and the outstanding balance will be paid on 31st December. The applicable interest rate is 20%, and the payment is only made in 2016, which is the following year, year end after 2015. Then in note number 3, you will see that they have sold a new type of cupboard that is water resistant because the cupboard is treated with a chemical that ensures that wood is not stained when water is spilled onto it. So of these cupboards, they sold 5 in total for cash on 1 January 2015, and it is for 5,000 Rand a cupboard. The cupboards have a 5-year warranty. Fair value of the warranties collectively in total is 5,000. On 31st December, one of the cupboards were returned. It had developed a white stain after being exposed to rain, despite its water resistance. So now you issued a warranty, you promised, but there's still a stain on it, and then the cupboard was repaired at 150 Rand. So they say you have to look at, in the required part, at note 1, note 2, and note 3, and complete the general journal entries to all these notes. So I've set up an Excel spreadsheet that I will now use to type the explanation for this question. So the first one we will start with is note number 1, and there we have a situation where we have an asset, or we have cupboards, that we have inventory that we've sold, and you will find that there's a number of payments that are being made, a number of installments. So therefore I need to start by making sure that I take into account the time and the interest. And in order to do this, I will compile what I call an amortization table. So the amortization table needs to be completed before I can type the answer fully to my sale that took place in note 1. So the opening balance there is calculated by saying, all right, I forgot there should be a column here that says date. That's also quite important. And we start off on the date, which is 1 January 2015. And the opening balance will be calculated by saying, right, there's 10 cupboards that are being sold, and they are worth 3,500 Rand each. So that's a total of 35,000. But before we continue, we need to also take into account on the same date that there's an immediate payment. So I need to minus the immediate payment of 10,000 Rand, and then I can start calculating interest on that total. So the first year end for which payment is received is 31st December 2015, and the opening balance there will then be the 35 minus the 10,000, which is 25,000. We need to calculate interest, and the interest rate is stated as 22%. So I'm going to take the opening balance and times it by 22%. I don't have to take into account any months because it's a full year. If you wish, you can say 12 divided by 12. So that gives you 5,500. I can fill out the installment that was given as 16,500. So the capital will be the installment minus the interest. So the answer for capital is 11,000. The closing balance is calculated by taking the opening balance, adding the interest, and minus the installment. The closing balance is then 14,000. The next year will be 31st December 2016, and there your opening balance will be equal to the previous closing balance, which was 14,000. You will have to calculate interest at 22%. Again, it was a full year, so you don't have to apportion for months, but if you wish to remind yourself, it will be 12 out of 12. The installment given was 17,080 Rand, which I type in, and I will then calculate the capital by taking the installment minus the interest, which gives me 14,000. The closing balance will then be as follows. Take opening balance, add interest, minus the installment, and you are left with 0. So this will be your amortization calculation that you should perform. Once you've done this, you can now continue and progress to filling out the general journals. And we will start on the transaction date, which is 1 January 2015. On transaction date, we need to recognize the debtor. So we will debit the debtor's account and we will credit the revenue sales. And the amount that we recognized first and foremost is the original opening balance of 35,000. Thereafter, we have to take into account that an immediate payment was done. So we will debit the bank and credit the debtor's account. And the immediate payment was equal to 10,000, as we can observe in our amortization table. Then we should not forget, and it's easy to forget, that we need to take into account that there's a perpetual inventory system. So therefore, we will debit the cost of sales and we will credit the inventory account. Now it's important to understand the type of markup that we are working with. So the markup that we are working with is a 40% on selling price. So you'll have three inputs. You'll have your cost price, you will have your profit, you will have your selling price. Because the markup is on selling price, the 100% is allocated standard to selling price. The profit is given as 40%, which means the cost price must be 60%. So cost price plus profit must be equal to selling price. Therefore, we say 100 minus 40 gives you 60. So this is the markup in terms of percentage. We must also calculate it in terms of currency. And we do have a selling price. The total selling price was 35,000 Rand. To calculate the cost price, I will then say the 35,000 divided by the percentage that goes with it, 100, and I will times it by the 60% that I wish to calculate, and that gives me 21,000 Rand cost of sales, and that amount will then be displayed as my debit and my credit for that journal entry. After performing all this, our entries are complete for the transaction date. We will then move on to year end, which is 31st December 2050. There we need to recognize two things, that there's interest that needs to be recognized and that there's a payment that needs to be received. So to recognize the interest, I'm going to debit the debtor because the debtor owes me more, and I will credit my revenue account, but the interest one. Then I've already done a calculation for this, so I will refer to my amortization table and see that the interest for that year end was 5,500, and it will then come and stand there. There's the 5,500. Then I need to recognize that payment is received, so I will debit my bank account and I will credit the debtors. And I know I have to account for my installment, and the installment is 16,500. I am done with my year end 31st December 2015, so I will now move on to 31st December 2016. There again, I need to recognize interest. I need to recognize that a payment is being received. So I will again debit the debtors account, if I can ever just spell it correctly, and I will credit my revenue interest again. I have done the calculation already, so make sure that it does correspond. The interest there should be 3,080. So there we go. I'm going to use that amount for the interest that is due to me. I received my last payment, so again I debit the bank account and I credit the debtor. The installment that was displayed there was 17,080, so I'm going to use that. And there is all the possible journal entries that I can account for when I do my or answer note number 1. Right, we must progress to note number 2. So I'm just going to copy this layout and scroll down. Right, we are on note number 2. And in note number 2, we had a situation where there is a sale and the payment is deferred. There's a single payment that is deferred. So the transaction date there was 1 March 2015. And we have a sale of an asset after discount. So it's a sale, so I'll say I debit the debtor's account. I credit the revenue interest. No, a revenue sales, I beg your pardon. There we need to go and find out, but what is the amount that is actually owed by the debtor? So the selling price there, let's do a calculation this side. We'll say that it's 4,000 rand per cupboard, and apparently we sell 25 of them, which gives us a total of 100,000. There's a discount of 10% because they buy in bulk, so therefore their total debt after 10% discount will be 90% of the original debt. So I'm going to times that by 90, and that gives you 90,000. So the sale there is 90,000. Please remember that we are busy with a perpetual inventory system. So on transaction date, we're going to say we debit the cost of sales. We credit the inventory account. And now we need to go and calculate the cost of sales. Please remember that the cost of sales will be based on the original full total and not on the discounted price, because the discounted price was a discount that was granted to the customer. And just because you give discount to the customer does not mean that you also receive discount from the supplier simultaneously. So you must use the full amount to get to the original cost of sale. Again, I am going to set up. We are working with cost price, we have profit, we have selling price. We know it's 40%, it's on selling price, and therefore the percentage that goes with the cost price must be 60. If I calculate it in rand terms, I know that the 100,000 rand was the 100%. So here I'm going to say the 100,000 divided by the percentage it represents times the 60 I want to calculate, and that gives me a 60,000 rand for cost of sales. Right, and after that I can progress to my year-end calculation, and the first year-end that we will have is 31st December 2015. Here we have to recognize interest. No payment is yet due, so we will only calculate interest. So I'll say I debit the debtors account. Now I will credit the revenue interest. And I need to do a calculation. And the calculation will be the outstanding debt, 90,000 Rand, plus the previous interest. I've not calculated previous interest, so it's plus 0. And I'm going to times that by 20. And I need to count the months. For how long has the debt been outstanding? And that is March to December. So it's going to count March, April, May, June, July, August, September, October, November, December. That's 10 months. So I'm going to times by 10 out of 12. In performing that calculation, I get to a total interest of 15,000. And that is the only entry to be done at year end because no payment was yet received. The year end after that will be 31st December 2016. And here I need to now do two things. I need to calculate interest once more, and I need to take into account that a payment should now be received in full. So I will repeat again, debit the debtors, credit the revenue, interest, and here I'm going to do a calculation again, but I need to take into account that I have calculated interest before. So now it's going to be the 90,000 original debt plus the 15,000 interest. I'm going to times that by 20%, and I'm going to take into account that it was now a full year between December 2015 and December 2016. So when I do that calculation on my Excel, I get 21,000 interest that is due. Thereafter, I need to recognize payment, so I'm going to debit my bank account and I'm going to credit the account debtors because they will not owe me money anymore. My total amount will be all the amounts that are now due by the debtor. So it's the 90,000 plus the 15 plus the 21. So if I do that calculation, it will be all the interest plus the original debt, and he needs to pay 126,000 to settle the debt in full. That is then the calculation that you should do for note number 2, and then we can progress to note number 3. So in note number 3, we are dealing with a warranty. So I just want to quickly copy and paste the layout again to make sure that you follow. Right, in note number 3, we sell cupboards, and one of them are now damaged on the last day of the year, so we need to make sure that we account for the warranties and the cost of sales when it is repaired. So the first date we will account for is the date of sale, and this was 1 January 2015. I will debit and now you will see it's bank account because the sale was for cash, and I will credit my revenue sales, and I will credit my income received in advance. just want to make sure that it's proper. The income received in advance is quite simple. It is the fair value and it was given to us as 5,000 Rand. The bank account will be the total, and they say that it's 5,000 Rand for a cupboard, and there's 5 cupboards that are sold. So it's 5,000 Rand times 5 cupboards gives us 25,000. The balancing figure will go to sales, and that is then 20,000. That is what I will recognize on transaction date. Then as time progresses, we reach year end, and at year end, we have an entry that needs to be done. Let me just spell this income correctly. Thank you. There's an interest that needs to be, or there's a warranty that needs to be recognized. So there's one of the cupboards are brought back. So for 1 year, we can now recognize the income in advance as revenue. So I'm going to debit income received in advance. I am going to credit my revenue, and it will now be services or repairs, whatever you want to call it. And I can recognize 1 year. So I know 5,000 is for 5 years, which means that it is 1,000 Rand a year. And then we need to take into account furthermore that there were a total of 5 being sold. So this will then be 1,000 divided by 5, which gives you 200 Rand that can be recognized. Then there's another 150 Rand that is incurred in order to have the repair be done. So in order to account for that, I'm going to say debit the cost of sales, and I am going to credit, and they don't tell me if it was paid for or not, so I'm going to say credit either bank or creditor if it is still due, and it is a total of 150 Rand. Right, so that was note number 1, 2, and 3. I think it's quite straightforward if you understand. If you don't understand, you need to make sure that you practice. Practice makes perfect. And here's a few little tricks that you had to take into account. Thank you very much for watching this video, and I will then see you again in class.